investment offer iSectors. I'd like to thank you for joining us today to review the iSectors third quarter 2018 performance update. I will be providing a brief third quarter performance overview of all the iSectors models, an introduction to a new way to get diversified income for your clients, and a research piece on the one factor you should follow in the stock market. This call should last about 10 minutes with questions and answers to follow. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded, and a copy will be available on our website tomorrow at www.isectors.com. Just click on the iSectors blog icon, and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after this call. Both the iSectors post-MPT moderate allocation and the post-MPT growth allocation fell behind their benchmarks in the third quarter and over the past 12 months. These strategies have been helped by the technology and financial holdings, but Treasury bonds lag the market as interest rates increase. As presented in the chart on slide 3, post-MPT growth, which has an S&P 500 benchmark, has become very conservative. Less than 30% of the allocation is invested in stocks not sensitive to interest rate changes. The rule-based model behind this strategy indicates that the 10-year Treasury at around a 3.20% yield have better valuation than equities given the data being released. Also, the model has no appetite for leveraged ETF exposure currently. Post-MPT moderate has a similarly conservative position with overweighted allocations to Treasury bonds, financials, and utility. The iSectors post-MPT allocation continues to outpace other comparable ETF portfolios. We are pleased that growth was ranked second among all 32 growth allocation ETF strategies for 10-year performance as of September 2018 in the Morningstar ETF Managed Portfolio database. Both the iSectors global equity and domestic equity allocations fell behind their MSCI All Country World and Standard & Poor's 500 benchmarks in the quarter. But domestic equity has been the best performing iSectors allocation in the third quarter and over the past 12 months. Both domestic and global equity allocations benefited from growth stock and growing dividend holdings. Emerging markets decline negatively impacted global equity. The iSectors domestic equity allocation has earned very attractive returns over the past 5 years. Compared to most U.S. equity portfolios, in fact, the domestic equity allocation is in the top 3% of all 678 ETF strategies in the Morningstar database for 5-year performance, even though it's been underweighted to high-flying growth stocks. The pairing of iSectors post-MPT growth and domestic or global equity has been a very powerful combination historically. During a time of rising interest rates, the iSectors domestic fixed income allocation is providing protection for fixed income investors. For both the second quarter and year-to-date periods, domestic fixed income has earned returns, while the Barclays Aggregate Index turned in flat to negative returns. Its strong positioning in high-yield securities, whose interest rate payments offsetted rising interest rates, contributed significantly to its positive returns. The iSectors global fixed income allocation was helped by international high-yield securities, such as the iShares International High Yield Bond ETF, or HYXU, as plotted on the graph, and preferred stock weightings in the quarter. The allocation was hurt by mortgage, such as the Vanguard Mortgage-Backed Securities ETF, VMBS, that was negatively affected by interest rate volatility. The iSectors inflation protection and precious metal allocations were negative in the third quarter. Gold bullion had disappointed returns, as shown by the slide 6 by the plotting of the Sprott Physical Gold Trust, PHYS, while palladium bullion results were positive, as presented by the Aberdeen Standard Physical Palladium Shares ETF, PALL. Even with the negative third quarter result, both inflation protection and precious metals have outperformed most standard fixed income strategies over the past 3 years and may continue to be better equity diversifiers than bond index funds. The iSectors liquid alternative allocation beat its hedge fund benchmark in the third quarter, as indicated on the chart on slide 7, representing a low core long short commodity strategies fund, LCSAX. Hedge strategies were strong relative performers in addition to alternative funds. As previously indicated, precious metal securities hurt the results of the strategy. The liquid alternative model is broadly diversified and aims to reducing total risk in client portfolios. Also, the liquid alternative allocation has outperformed hedge funds over the past 9 years. Given the advantages of the allocation, including daily liquidity, complete transparency, availability to all clients, not just accredited ones, and a current yield of 2.6%, liquid alternatives will provide attractive risk-return characteristics as equity returns continue to ease. As you know, iSector's sole mission is to serve our financial advisor clients. We do not have individual clients of our own. Our advisors have been asking for a high-income strategy for their clients who want to live off their income. We have been concerned that most of the offerings in the marketplace are not well diversified. In the first half of the year, we completed a study of high-income ETFs and mutual funds and determined that we can enhance our endowment allocation. We have changed the model's objective to producing a high level of current income protecting principal. The current endowment allocation is composed of 16 funds, almost one-half equity and one-half fixed income, that have low to moderate correlations to each other, while earning a portfolio currently of 5.3%. Scott Jones or I will be happy to discuss the strategy with you if you have clients that would be interested in. The iSector's Tactical Global Balance allocation underperformed its benchmark in the second quarter. Broad U.S. large cap equities, as graphed on chart on slide 9 using the price movement of the iShares Russell 1000 ETF, IWB, enhanced returns, in addition to broad U.S. small cap equity holdings. The Vanguard Real Estate ETF, VNQ, hurt results. This trend-following strategy has sold out of all of its positions, and it's now 100% in cash. The chart on slide 10 indicates that the iSector's capital preservation allocation has earned over 2.5% on an annualized basis over its 8-year life, during a time of very low interest rates. The yield is attractive with a short duration while maintaining investment-grade quality on average. Capital preservation rose during the quarter due to short government bond holdings. Given all the cross-currents in the recent market correction, we thought we would increase your focus on the most important factor that drives stock prices over the long term. Although investors have been about rising interest rates, trade policy, and even the midterm election being held today, David Kelly at JP Morgan says that the market is monotheistic. It only has one God, and that is earnings growth trends. The chart on slide 7 presents earnings growth and their sources on an annual basis since 2001. Pay particular attention to the orange diamonds that plot total earnings growth. Dr. Kelly shows that the market started to recover from the 2000-2002 bear market when it became clear that earnings growth turned positive. When earnings growth went negative in 2007, the 2007-2009 debacle took place. Once earnings growth turned positive again in 2009, the market recovered. Now watch the next movement carefully. Even though 2011's earnings growth was positive, it was significantly slower than in 2010. This resulted in a 19% Standard & Poor's 500 decline in that year. Once again, when earnings growth turned in 2015, there was a 14% correction in the 2015-2016 period. As you can see, earnings growth rose from that point to the almost 30% year-over-year level JP Morgan expects in 2018's third quarter. We and many other market participants believe that we are at the top of earnings growth due to the effects of the tax bill, the relatively low level of interest rates, and production that took place in front of threatened tariffs. All three of these items are going away during the upcoming quarters, which will result in lower earnings growth. Expectations is that in 2019, earnings growth may be somewhere in the 10% range. This leads us to believe that the current action may be the beginning of something bigger. As you carefully inspect the disclosure page, we will now begin the Q&A portion of the webinar. If you have any questions, please type them in the chat box in the lower right-hand corner of the screen. We have our first question, and that is, would you recommend a domestic equity strategy or the global equity strategy going forward? Well, we think that they're both great strategies. They both have a dividend tilt to strategy, and starting to see dividend stocks and value stocks doing well. The global equity strategy obviously gives you the greatest amount of diversification since you have international stocks in that strategy. We are concerned that as long as interest rates remain high, the US dollar may continue to perform well. And if that happens, then that will impact the stocks, the returns on global stocks. For the most part, we're happy with the domestic equity strategy, and for the most part, we probably would still want to focus on that strategy going forward. Seeing that there are no other questions, I wish to conclude today by thanking everyone who attended this webinar. If there's anything we could assist your wealth management or 401k asset allocation needs, please let me know. We could be reached directly at 800-869-5184. Again, thank you, and we hope you have a fabulous holiday season.